We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome back to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod. He's head of research at Goldmoney. How are you today, Alasdair?
I'm fine, thank you. And thank you for asking me to be on your show, Tom.
It's a pleasure to have you. I've been looking forward to speaking with you for quite some time. So it's great to be able to actually chat finally. So I'd like to start by having you explain the difference or having you explain the price action in gold coming into December here and why the expiry of the COMEX December options play a large role here.
Yeah, since this bull phase started, which was December 2015, every December, apart from just on one occasion, gold has fallen heavily into December. And it's really the end, if you like, of the option cycle and the active contract, the December contract, the last day of trading, all that sort of stuff happens at the very end of November. After that very big fall, the market has bounced hugely. I mean, really, really substantially. The only time that it didn't follow quite that pattern was in December 2018, when the market didn't fall into November, but after December, it continued to rise. So on seasonalities, December is an extremely good time to get into gold. The problem really at the end of the year for the bullion banks is that they do have these option expiries. And this time in particular, there was a big run up with lots of people suddenly realizing, my goodness, they're going to be printing money until forever. And therefore, gold, we've got to have more gold because it is an inflation hedge, etc. And what they were doing was they were buying out of the money calls. Now, consequently, the December calls, which matured at the end of last month, there were about 150,000 of them at 1,800 strike and above. So you can see the incentive for the bullion banks to move the price down from over 2,000 all the way down to below 1,800. They wiped out 150,000 call options and pocketed the premiums. Very nice work if you can get it. And that, I think, is one aspect of it. The other aspect of it is that when you come to the year end, from the bullion bank trading desk's point of view, they have a major accounting thing. Their position gets valued and all the rest of it. Now, they're all desperately short, so they need to get the price down as much as possible. And part of this really is persuading everybody that gold is not the thing to have. Take your profits, sell your ETFs, whatever it is. In other words, they really want to shake the trees as much as possible. I was just looking at the commitment of trader figures for last Tuesday, which was released yesterday because of the Thanksgiving holiday. And they are still short in terms of money, something like $35 billion net. Now, gross, the figure is about 50. So this is a huge short position amongst around about 30 bullion bank trading desks. I mean, to be short an average of $1 billion worth of gold each is a very, very painful experience running into their accounting period at the end of the calendar year. So, it's for all these reasons that they really hit the price. Now we have the situation where the real reason for hitting it, getting rid of all those call options, pocketing the premium, etc., having got the price down as much as possible, they've really begun to run out of steam. And we've seen today, and this is being recorded on, Tuesday, Tuesday the 1st, yep. We've seen today that the gold price is up $33. Why? I mean, the pressure is basically off, and now nothing goes up in a straight line, but you can see that how the dynamics behind the market will have altered very substantially, and it looks like we're in for a rerun, as I said, of every December from 2015 onwards, and this time with almost a record short position. I mean, the worst they have been is something like $39 billion net short. They're still $35 billion net short, despite getting the price of gold down from a record back in early August of 20,075 down to just below 1,800. They are still massively short. So this time, I think the squeeze on them is going to be very substantial, and we could end up with the sort of market dislocation that we saw after they hit the price. The bullion banks hit the price, got open interest down from, I'm trying to remember the figures. I think open interest in gold was round about just under 800,000 contracts. They got it down to about 455,000, which is roughly where it is today, by the way. And yet after that, we had a real squeeze on the bullion banks, and we saw that there was no stock available, no physical available. There were people actually standing for delivery in the market on the active contracts, and incidentally, they're doing it this time as well. I mean, it looks to me as if the final delivery demands will be around about 95 tons of gold, which is quite a lot of gold, really. And the market wasn't really invented for this to happen. And if you look at London, I mean, the idea that there's plenty of gold in London, which the LBMA continually tells us, that's not true. Yes, there's about 8.8 thousand tons of gold between LBMA member vaults and also the Bank of England, but it's all spoken for. I mean, it's either central bank stuff or it's owned by ETFs, which have grown massively, really, over this last year. And if you take that into account, there's very little liquidity in London. So it is a tight liquidity situation in terms of the relationship between physical and paper. So I would expect going into 2021 to see really quite an interesting market. Let's put it that way, and particularly since the background is one of unlimited monetary inflation. I mean, really unlimited. That is what Jay Powell said back on the 23rd of March. We'll do whatever it takes. That weren't quite his words, but he was echoing, if you like, what the ECB said when they had the crisis about 6 or 7 years ago. And they will do it. I mean, we've already had a huge, great injection of money into the American economy. We're talking dollars, of course, which is why I'm referring to America. We're about to get a second one once the mess over the presidential election is sorted out. And the effect on that, I think, is you were already seeing this in the dollars trade weighted, which is breaking into new low ground for 3 years. It's looking extraordinarily weak. We're beginning to see the yield on the 10-year US Treasury rise. We've got a golden cross on the 55-day and the 200-day moving average with the price above it. I mean, the technicians look at that and say, this chart is going north. And we're talking about the yield. We're not talking about prices. We're talking about falling prices. Mm. And the mix of this, I mean, if you look at the history of how monetary inflation begins to be realized in price inflation, the first effect, if you like, is on the foreign exchanges. We're seeing that with the dollar now. And I mean, people kept on telling me last year that, the dollar will never go down. The foreigners always need it. It's the reserve currency. When there's a liquidity problem, everybody's got to go and rush into dollars and all the rest of it. Well, I'll give you the facts. The facts today are that the foreigners own roughly $28 trillion of dollars and dollar investments. In that is over $6 trillion of bank deposits and short-term monetary instruments, particularly things like treasury bills and the like. So there is no shortage. And not only that, but if you remember back to September 2019, we had a liquidity crisis in the repo market. Now, the repo market is, when you got a liquidity crisis in the repo market, you have a bank liquidity crisis, full stop, because that is the market which matches it's the sort of wholesale lending and borrowing between the banks. And they drove the right rate up to 10% before the Fed got a hold of it and injected massive liquidity into the system. So we have got problems in the banking system which are rumbling on underneath this. And I can tell you that just jacking up the reserves doesn't resolve the problem. The problem is that the banks have lent too much credit out there. There's too much credit out there, and they want to contract it, which again, people get confused about because a lot of them understand the position that the banks are in with their balance sheets over-leveraged compared to their equity, and particularly the market rating of that equity. I mean, if you look at the relationship between assets, total assets, balance sheet assets, and the market capitalization of a bank in the market, in Europe, you're commonly seeing banks on that basis 100 times. The relationship between assets and market capitalization over 100 times. I mean, this is staggering. It is indicative of a banking system which is in failure. I mean, the only thing that hasn't happened is that the banks haven't actually gone bust and told us that, my goodness, we got a full-scale systemic crisis. But it is there. It is there. So what this means is, in terms of monetary inflation, is that it's not just a question of COVID-1, COVID-2, COVID-3, perhaps. It's also a question of the fact that if you look at the cycle of bank credit, we are overdue a contraction in bank credit. And a contraction in bank credit inevitably produces a systemic crisis if the contraction is significant. So I think, sort of reeling back a little bit, one of the Fed's objectives, which they won't tell us, is actually to ensure that no banks go bust. They don't have too much of a problem doing that, I think, in the United States, because the banks generally are reasonably well capitalized when you compare them with the Eurozone. The Eurozone, and also Britain, has massive gearing on their banking system. And if you get the commercial failures from COVID beginning to impact on the banks' non-performing loans and all the rest of it, I mean, it is absolutely clear we're going to have a banking crisis. Now, whether they manage to smother it or not is another matter, but there is a banking crisis going on as we speak. So the important point about that is that the monetary inflation, we've had one, we're about to get another, and that's on COVID, but it's going to go on after that because of the banking situation, because we got zombie companies which should have gone bust years ago, being supported by the banks and being supported by the system, the crony capitalists, if you like. They've got to go bust before we can actually move ahead. So the sooner it happens, the better in that sense. But of course, the last thing the politicians want, the last thing that the central banks want, is to see bankruptcies, rising unemployment, and all those things. They want every excuse to just throw more money at the situation. And if it fails, not on my watch. When I'm gone, someone else can deal with the problem. And that's really where we are.
Absolutely, Alasdair. And there's so much to unpack there. So why don't we start by having you explain how interlinked and interdependent all these European banks are, and explain the Target 2 system for us.
Okay. Now that's an interesting one. The Target 2 system is the, if you like, the cross-country settlement system between the national central banks and the ECB. And it is effectively run by the ECB. So if you have a situation, let us say, where a German company exports machinery to Italy, normal case, typical case, what happens is that the payments from Italy go from the buyer, the company's bank, if you like, to the central bank, which is the Banca d'Italia. It is then routed to the Bundesbank, which is the German central bank. And the German central bank on the routing instructions knows that they've got to credit the account of the manufacturer's bank. And when that bank account is credited, then the manufacturer will find that in his bank account, at his bank, he's got a credit which has come from the Italian, effectively, the Italian end customer. So that is how the system routes through. Now, this obviously leaves a monetary deficit, if you like, in the Italian central bank and a surplus in the Bundesbank. So, but the way that in the past used to be sorted out was really quite simple. German tourists would go to Italy and they would spend money as tourists. And not only that, but investors, if you like, would invest in Italian bonds so that German investors were recycling the capital, as it were, by those means. So that's how the Target 2 system basically works. But we have a problem. And that is that local regulators looking at the banks, so let's go back to Italy again, they had a huge level of non-performing loans. I'm going back over the last 4 or 5 years, huge level of non-performing loans. I mean, something like 20% of GDP was non-performing loans in the banks. I mean, we're talking massive figures. And when you bear in mind that the Italian government is at least half GDP, what we're saying is that 40% of the loans in the Italian banks were non-performing loans. This is a staggering figure. How do they deal with it? Well, it's quite simple. What happens is the local regulator says, we've looked at this and we're happy to sign them off as these loans being viable. Now, what that then means is that the Italian commercial bank can then go and borrow money from the central bank using these non-performing loans as collateral. So what you're doing with this is that the Italians are removing the non-performing loans from being a national problem, and they're just dumping it into Target 2. And the result of this is that you've got huge, great imbalances developing. I mean, the Bundesbank is now owned over €1 trillion by the other central banks, plus the ECB. Now, the nasty thing, I mean, they don't say anything. They really don't say anything because in their balance sheet, they have got this, these loans, which are lovely and look great because it comes from national central banks and therefore risk-free. But the moment they turn around and say, hold on a minute, we've got a problem because we're getting owed huge amounts of money and we know what's going on in Target 2. We know that there are bad debts in there and we know that the situation isn't sustainable. So we're going to stop taking in loans. Now, they would then collapse the Target 2 system. But what would happen to the Bundesbank is instead of being owed 1.2 trillion euros, they would be on the hook for 400 billion euros, because that is their key, if you like. It's what they call the key, which is the relationship that the Bundesbank has in terms of shareholdings in the ECB. So they would then be down for the loss, because the loss goes on to the ECB's balance sheet and the bailout basically has to come from the national central banks. So nobody dares say anything, but this is a frightening situation. The banks are bust in the Eurozone. Of that, there is absolutely no doubt. And it is only a matter of time before this really does surface. And it could surface perhaps because the British banks might be in trouble. I mean, we've got pretty high gearing, if you use the metric which I described, between the balance sheet total and the market capitalization of a bank like Barclays. I mean, I haven't looked at it recently, but you're talking about 60 times, something like that. The other problem we have is that we've got two very large banks here who are very tied up in Hong Kong and China, one being HSBC and the other being Standard Chartered. Now, they are not as highly geared as the Barclays of this world, but having that relationship and having, if you like, a sort of a trade war and a developing financial war between America and China, you can see that we've got two large banks here which do, if you like, give us a systemic risk back in the UK. So anyway, that's the situation over target 2, and all those bad debts are hidden in target 2. Negative interest rates basically have been killing the banks in terms of their profitability, and I suspect that the feeling in the ECB is that the day in which they can do without commercial banks will be a happy day for the ECB, particularly if we can get in place central bank digital currencies so that everyone in the Eurozone can have an account at the ECB. And by everyone, I mean every consumer and every business. And that basically is the whole idea behind the central bank digital currencies, though it will take time. And I think it'll probably take too long, given the way monetary inflation is speeding up, to ever be introduced. And I hope that it is never introduced, for the very simple reason that we just completely lose the freedom to do what we want with our money.
Absolutely. And I think you make a very interesting distinction there, Alasdair, and let's flesh that out a little bit more about the true definition of inflation versus what its effect actually is.
Yes, the classical economics definition of inflation was an increase in the quantity of money in circulation. As simple as that. What happens to prices as a consequence of an increase in the quantity of money in circulation is a different matter. Nowadays, we call that inflation. Now, this suits the central banks, it suits the Keynesians, it suits the macroeconomists, because it gives them a target, as it were. By deflecting everyone's attention from what inflation really is, and then managing the outcome in terms of providing some sort of statistic which covers the change in the general level of prices, in other words, the CPI. If they can control that statistic, then they can inflate the money supply as much as they like within some sort of reason, and that then becomes a major monetary management tool. So that is why it's gone the way it is, that everybody talks about inflation being prices rising. It's not prices rising. What they're concealing is the fall in the purchasing power of a currency which is being over-issued. And by over-issued, I mean issued in greater quantities than the economy really demands, which is what governments do. It has now become a major source of financing. I mean, if you look at the second half of the last American fiscal year, the rate of financing of through monetary inflation was twice as high as their income from taxes. Now, if you spread it over the year, this factor is concealed. But if you just concentrate on the last 6 months to the end of September, which is the second half of the American fiscal year, make the adjustments in terms of loss of taxes. I mean, all this stuff is available on the sort of official websites, if you like, American government websites. But you chase it through, and already they are funding the deficit, or they're funding not the deficit, but all government expenditure is being funded twice as much by monetary inflation than it is by taxes. Now, that's a horrifying thought. That's we're now talking about sort of territory which they had in the 1920s in Germany, and this is serious. I mean, this really is serious, Tom.
So, Alasdair, let's talk a little bit about the trap that these governments find themselves in, where they can't ever choose to try and reverse course and actually try and shrink that debt. As you're saying, the government in the U.S. is financing 2/3 of their spending this year alone by printing money. So how is that, like, let's say, cyclical trap just perpetuating?
Well, it's perpetuating because of one very simple fact, which the macroeconomists never ever tell you. And that is that through monetary inflation, you are transferring wealth from the productive sector to the government, which is generally non-productive. I mean, the government will always argue that, of course, they are productive, but they're not. They're not productive in the sense that they're not making things that the consumer actually wants. I mean, I don't deny they spend money on things. Of course they do. But, this is not consumer-driven demand, if you like. So if you're going to impoverish the productive side of the economy by repeated tranches of monetary dilution, then you're just impoverishing, everyone who is not in government. Government government gets the benefit. The big banks get the benefit when they expand bank credit. I mean, a license to print money is a banking license. Wonderful. But that is not the environment we're in. They're now worried about the other side of it, which basically means that the only thing really that anybody is elected to do is to just chuck money at the problem and ensure that companies don't go bust and unemployment doesn't rise. So they're stuck in this awful sort of situation where the more they print money to sustain the current economy, the more they weaken the economy itself. They don't actually realize, perhaps, that they're weakening the economy, but they would rather turn a blind eye to it, because if they realized that, they would just shoot themselves. I mean, we're stuck. What can we do? Nothing. So it really is a very, very serious situation. And on every tranche of massive money printing, which is now what we're into, the situation just gets worse and worse and worse. But nobody can stand up and say, stop, this is ridiculous, because nobody's elected to do that. Nobody's strong enough to do that. They're all in the position of the board of the Bundesbank, who can see their balance sheet is actually gone bust. Why? Because they're owed money that they'll never be paid. But do they say anything about it? No, can't do that. We don't want to break the system. Mm-hmm. So, and that's really, I think, where the point we have got to. And I think it's sort of understanding that you begin to understand what really drives these sort of hyperinflation of money, and the subsequent rush out of money and into anything but money. And that is the final collapse of the purchasing power of money. We're on course to go there, which is why I have described what has happened in America on COVID-1 as putting America very firmly into a hyperinflationary course, because there is no exit, and it's just got to go, more and more rapid for the same real transfer effect to the government. But the more they transfer from the productive sector of the economy, the more they kill the economy. So this is an awful situation from which nobody is strong enough to accept what is required to escape from it. And that is just stop printing money. And that puts central bankers out of work. I mean, and this is the problem. But, at some stage, they're going to have to face up to that reality. And I mean, the only way out of it, so far as I can see, is that at some stage, whether it's the government or the central banks, are going to have to stop this. And they will probably do that when they see the purchasing power of their currency collapsing to such a great degree that they can begin to see that if it continues, and it looks like it's almost certain to continue, the currency itself will be worthless. So the only thing they can do at that stage is mobilize their gold reserves. And by that, I mean make their currencies if you like, gold-backed, make them act as gold substitutes, which basically would mean that you in Canada would go to the central bank and swap those paper notes or your digital deposits in your bank for gold. Oh, I forgot, you've got no gold.
That was my next question. How does that work for a short-sighted central bank like Canada that sold it at, I believe it was less than $300 an ounce US?
Yeah, I mean, well, we did the same. I mean, the infamous sale of 2/3 of our gold reserves back, I think it was 2000, round about then, by Gordon Brown. I mean, it was just... this was Keynesianism gone mad. I mean, it's quite simple. And now we need those gold reserves. America has substantial gold reserves, allegedly. So, there's some doubt. I mean, I know that there's sort of, we can be called conspiracy theorists and all the rest of it. The answer is we don't know how much gold America has. But the US Treasury, if it does have over 8,000 tons of gold, it can monetize the dollar. But obviously not at anything near current levels. I think we'll be looking at a far higher level. The other problem is that it's one thing to monetize gold that way, remonetize gold, back your currency with gold, but you've got to do it in a way which is sustainable, which you can sustain. And by that, I mean that you have to do away with all that deficit spending. You have got to reorganize all government spending so that you don't have deficits. That is desperately important. You have to contract the involvement of government in your economy. That is vital if you're going to make conversion, if you like, gold backing of your currency stick. Without that, you're going to have problems, and you're not going to have what you find is that people will say, well, we'll just have to convert as much of this paper rubbish into gold while we can, because it won't solve the problem unless the government actually really cuts its spending and, more importantly, begins to move or plans to move, and this is the only planning I will accept in government, plans to move their involvement in the economy towards no more than 20%, and preferably even less than that.
Some crazy figures there, Alasdair. So as we're talking here, you're a real student of history. So can you point out some of the similarities between the situation of the 1920s and what we're starting to head into today?
Yeah, I mean, throughout history, there are lots. I mean, the very simple one is that any government that relies on printing money to finance its deficits will destroy its currency. And this is what happened in Europe following World War I. Now, people say that Germany's problem was reparations and the French walking into the Ruhr at the beginning of 1923. Yeah, I can accept that as a cause, but then you need to explain why it was the Austrian currency collapsed, the Polish currency collapsed, and the Hungarian currency collapsed. I mean, the reason is quite simple, that the bills were paid by printing money. That is, it doesn't matter what the bills are, but if you're going to print money in order to pay them, then you're going to destroy your currency. There is another far earlier parallel, which I think, in a sense, is very, very similar to what we have today. And that is what John Law did 300 years ago in France. John Law managed to persuade the Duke of Orleans, who was the young King Louis XV's regent, to give him a banking license. And, he worked with the Prince Regent in order to, if you like, the objective was to sort out the king's finances. The state and the king were the same thing in terms of finances. And the king was very heavily in debt. He'd built Versailles. I'm talking about the then king's father, Louis XIV. He built Versailles and all the rest of it. And as usual, just spent huge quantities of money. The nobility didn't pay any taxes. It was always, tax was collected from the poor, from the farmers, and all the rest of it. So this was a very difficult situation. Effectively, France was bust. Along comes John Law and says, I have a plan. And he told the Duke of Orleans that the answer basically was to finance, if you like, an expansion of the economic activity by making money freer to use, to move, sorry. And out of this, he intended to make enough money to help pay off the king's debts. I won't go into the detail of that, but we got to the stage where he then turned his commercial bank, with the agreement of the Prince Regent and the Parliament of the day, into what, if you like, a prototype central bank. It became the Banque Royale, in other words, the nation's bank. And he was able to issue currency, his livre, in return for, if you like, specie, as they called it, gold and silver coins, which were submitted. He pushed out these livres. Then he had a parallel project, and that was to acquire the Mississippi Company, which was basically a collection of licenses to import goods and everything else from France's American colonial interests. He then managed to get also the interest from the Indies. In other words, he ended up with a license, if you like, to bring in all France's imports in, and this was in about 1719. Now, he needed to build a fleet of ships in order to do this. So he then put together a scheme which on, I think it was January the 28th, 1720, meant that his Banque Royale would merge with the Mississippi Ventures, and he needed to get the price of the Mississippi Venture up in order to do it. So he printed money to buy shares in the Mississippi Venture and thus drive up the price. And he had to do this as well because earlier issues, both of the bank stock and also of the Mississippi Venture, were in partly paid form. And what he wanted to do, what he had to do, was to ensure that the enormous profits that people had made by putting down 10%, say, of their entitlement with the rest to come, is to stop them selling, he needed to have further issues. So the thing was a pyramid, if you like. Now, it got to the stage where very late in 1719, around about November, the currency began to weaken. It began to weaken. I mean, the place was flooded with these new livres. Prices for food were shooting up, which meant that there was sort of growing starvation in the provinces. And on the foreign exchange markets, the bourses in London and Amsterdam, the French livre was beginning to sort of sink a little bit. So this was getting more and more important, that he actually managed to get this merger through. And then, the whole thing would sort of sail on. Now, the similarity between what Banque Royale was doing at that time, printing livre to buy the one big asset, is very similar to the situation where the Fed is printing money to buy a whole range of assets. So, in other words, what we're seeing is what John Law did 300 years ago, occurring on steroids today. I mean, and the outcome of this was interesting because the livre by around about September, October had lost all its value. There was no exchange rate for it in London or in Amsterdam, but the shares priced in these worthless livres had fallen from a high of 11,000 livres down to a low of around about 3,000 livres. So in theory, they still had some value, but their value was in valueless currency. Mm-hmm. And it looks to me, I mean, quite honestly, what the Americans are doing, what the Fed is doing, is just such a dead ringer for what John Law attempted to do. And do you know the way to play this is not to short the the equity market on a real crash. You may well get the crash, but you short the currency. And that was what another person whose name will be familiar to many of your listeners, Richard Cantillon, did. He made his first fortune out of John Law by lending money to people who wanted to buy shares in both the Banque Royale and also the Mississippi Venture. What he did was he immediately sold the collateral, which was he was given, the shares that he was given, without telling the owners. And then later on, he went back to collect, basically, when the shares collapsed. But his second play on this was not to sell the shares in the market, but to short the currency in London and also in Amsterdam. And he cleaned up royally. He must have been one of the wealthiest non-royalty, if you like, non-nobility in the whole of Europe. I mean, and he ended up in London. He lived in London. He wrote his essay on economics, which is a very important essay. It explains how monetary inflation creates price inflation and how it works its way in through an economy and so on, and how the last person to get it finds the prices have risen. The first person who gets the new money gets the most benefit. The Cantillon effect. He explained all that. Anyway, he died in a fire in his house in Mayfair under very mysterious circumstances. His body wasn't found. And there was some talk that he might have escaped with a chest full of gold, documents, whatever, to South America. But so it's a lovely story, slightly adrift from what we're talking about, but it gives some color, I think, to the situation which the Fed now finds itself in. It has to keep government bond yields suppressed. Otherwise, the US government is demonstrably bust. And that is the problem, because as the purchasing power of the dollar falls, inevitably the yield on government stock is going to rise, simply because nobody is going to buy US government stock in a falling dollar without having an interest compensation, which will make up for it. And that cannot happen. That cannot happen. And therefore, we can see, another Richard Cantillon opportunity, shorting the currency because it is going to zero.
So something important that I think is worth highlighting in there, Alasdair, is that, and you talk about this quite a bit, is that gold isn't necessarily going up, but it's the value of the currency that it's measured in is going down relative to it, correct?
Yes, that's absolutely right. But I need to add something to that. Okay. The general level of impoverishment that comes from a fiat currency collapse means that as it progresses, the purchasing power of gold actually rises in terms of what it will acquire. Now, I'll give you an example, and this is something which I think all your listeners should bear in mind as we progress down this road. In late 1923, you could buy a 6-bedroomed house in the sort of the wealthy suburb of, or ex-wealthy suburb of Berlin, for $100 US. Now, bear in mind at that time that the dollar was as good as gold. Effectively, what you were doing was you were shedding out zillions of paper marks for just under $5. 5 ounces of gold. 5 ounces of gold could have bought you a 6-bedroom house in the poshest part of Berlin. So what we can say is that as the collapse of the purchasing power of the paper currency proceeds, the purchasing power of gold also rises. And it rises substantially because of the economic condition that is created by the collapse of the paper currency.
Because it is more a store of value, correct?
It's not just a store of value, it is money. That's the whole point. And at that point, you're using it as money. Austria had the same thing. I mean, they managed to stop their hyperinflation in 1922. And the person who was instrumental in that was Ludwig von Mises as an advisor to the government at that stage. But I mean, reading contemporary accounts of what happened at the time, foreigners were coming in and buying these massive Austrian estates. I mean, Austria was so wealthy. The wealth was completely destroyed. And you could pick up huge, great estates. You had the inflation king, Hugo Stinnes in Germany, who ended up owning a quarter of all Germany's production. And he also bought sporting estates and agricultural estates and housing property and all the rest of it. He was known as the inflation king, and his credit, his credit worthiness, if you like, meant that he could actually borrow money to buy these assets, paper marked, which ended up being completely worthless. So he ended up with no debt. Where he did come unstuck a bit was there comes a time when you need to move from just sort of owning gold, as it were, to actually being able to provide capital into the regeneration of the economy. And that has to be managed very, very carefully. But that is the other side of this valley of death that we're looking at. Stinnes actually died, I think it was early the following year, on the operating table. I can't remember what he had. He had a problem like, I don't know, I think it was bile duct or kidney or something like that. So he didn't really live to enjoy all his inflation-gotten gains, but you can see roughly what happened. So if you look at the situation today, I mean, we've got an American economy, Western economies, but particularly the American economy, which is a very financial economy. So the one area where this effect of falling purchasing power of the dollar is really affecting everybody now is they're moving into assets, financial economy, financial assets. Look at cryptocurrencies. I'm not saying that cryptocurrencies are the answer at the end of the day, but enough people think they are that they're running in, they're buying cryptocurrencies. And for all I know, I mean, they're going to shoot up. I mean, as we speak, Bitcoin is 19,200. I mean, having just sort of got very close to 20,000. Gold and silver have gone up, but it's not just gold and silver. In fact, gold has underperformed because of what we were talking earlier, the bullion banks trying to smash the price. The same is also true of silver. But if you look at copper, you look at lumber, very important to Canada. You look at soybeans. You look at the whole range of commodities and raw materials. And what's happened? All the prices have gone up. Look at the S&P and the Nasdaq. What's happened there? They've risen by something like 50% from last March. I mean, this is an inflation of assets. And when you get an inflation of assets, then the root of it is an inflation of the quantity of money. So we're already seeing this. I mean, the problem with talking about it in terms of consumer goods is that the statistics, you cannot actually measure the general rate, the general level of price increase. But you've got a huge, great gap between what the CPI says, which is 1.7% or something like that, and what, let us say, Shadow Stats says. Now, Shadow Stats is interesting because their estimate of around about 8-9% is based on the methodology of calculating the CPI back in 1980. And it was from there that governments began to realize, look, we have got liabilities. We have got inflation-linked liabilities because we have inflation-linked pensions, welfare payments, and so on and so forth. If we pay out on what's happening to prices, then we're going to be bankrupt. I mean, it's just impossible. So the statisticians basically were given an instruction to keep the level of the CPI, that, the inflation-linked bit for everything else was priced on, keep it as low as possible. And they've got it down to 1.7%. And if you look at the Chapwood Index, the Chapwood Index is currently saying that the rate of price inflation in America is over 10% and has been, incidentally, for the last 10 years, every year. And that has other implications. What's the GDP doing? I mean, has GDP grown to the point where, or let's say economic activity has grown to the point where that inflation, if you like, price inflation is compensated for by increased economic progress, value of, the extra economic progress? And the answer is no. I mean, when you get genuine price rises in the general level of prices of, say, 10%, and your economy has gone up in nominal terms, say 4%, you're minus 6%. And that basically has been the situation since Lehman.
Mm-hmm. So, Alasdair, there's one thing you brought up here is the value of Bitcoin here, and cryptocurrencies priced in a particular currency. So when these fiat currencies implode, is there a point to having these cryptocurrencies? And we can use today as an example where Bitcoin futures hit 20,000 and then proceeded to crash back to 19,000 in a matter of 10 minutes. So what are the other issues associated with cryptos here?
Well, the cryptos I find fascinating because a technologically competent element of the population has been educated to understand what governments are doing with fiat currency. This has never happened before.
This is what I was going to say is a very valuable piece, as you see it, of the cryptocurrency puzzle, is that it has had the effect of educating a good number of people about the concept of, or let's say, worthlessness of fiat money, or currency. Absolutely. Sorry.
Yeah, no, absolutely. And I mean, they always used to say that not one man in a million, man or woman, I suppose we say nowadays, in a million understands their money. Now we can't say that because there's a whole sort of cadre of people who are playing in the cryptocurrency market who actually understand that the reason they're there, I mean, obviously to make lots of money and the things going up and all the rest of it, but, they do stop and think, now, why is this happening? Why should I go and buy, say, Ether or Bitcoin or whatever? And, they go online and they sort of read it up and all the rest of it, and they realize actually what it is that Bitcoin is capped at 21 million, and there's going to be no more than that. And it's getting progressively difficult for the miners. Now, we don't understand how it works, but okay, who cares about that? It's getting progressively difficult for the miners to produce new Bitcoin as a reward for their, doing whatever they do. And compare this with what's happening with government currencies. We see that, there's QE and so on. Now, we don't necessarily understand what QE is, other than it seems that the central bank prints money to help pay for the government's spending and to support the economy or whatever. But the point is, an awful lot of money is being printed or magicked into existence, if you like, while Bitcoin is steady. That's not increasing, or it's increasing very, very slowly with an end point on it. So, it's a supply and demand situation. Yeah, I can understand that. But so they have now been educated about what is actually happening to their money. And this is a very, very different situation from anything we have seen before. Whether cryptocurrencies actually sort of survive, I don't think that they're suitable as money, really, for a number of reasons. I mean, firstly, there's a volatility issue. You need to, if you're going to be spending Bitcoin, then, you're going to want the variation in the price to be in the thing you're buying, not in your money. Yeah. And that's the advantage of gold. I mean, it's, gold is stable. I mean, the only reason it fluctuates is because it's the currencies that are fluctuating relative to gold. But when gold is money, it is stable. And that we know. You don't have that with cryptocurrencies. And the secondary problem from there is, just imagine you're a businessman and you, let's say Bitcoin is the global money or the money that you use. But you need to, you have an idea, and that is, as an entrepreneur, you want to make a new range of widgets, whatever it is. It requires investment, and the investment probably has to take a 10-year view. Okay, now with money, that's hard enough. You can do it because you can go into the market. You can probably fund it through the bond market. You could probably fund some of your current spending through the banks and so on. So yeah, that's all right. But how do you value Bitcoin in 10 years' time? You've got no idea. You can't make the business calculation that you as an entrepreneur have to make. So, that side of it, the capital side of it, basically just can't happen. And that, I think, is a huge, great problem. So I think that conceptually that gives us some very good guidance as to what happens in the future under a number of circumstances. If paper currency is destroyed entirely, then there is no doubt that the only escape from that, in my view, and I'd be delighted if anyone else comes up with something that they can actually establish as sensible. The only escape for that is that for central banks to mobilize their gold reserves, and gold then, through paper currency, becomes the money. Mm-hmm. Now, if that actually happens, and it happens in such a way that central banks and governments realize they have got to cut their spending, that's a big ask, I must admit, then there is no role left for Bitcoin, Ether is slightly different, but the idea of cryptocurrency, if you like, as a store of value, disappears at that stage. I'm just talking black and white here. Mm-hmm. The other possibility is, and I think this is unlikely to happen for various reasons, if we have an Argentinian situation where the currency never quite dies and it just goes on and on and on and on, then your Bitcoin does have a role under those circumstances in terms of preserving your wealth. There will be enough people buying it, if you like, to get out of a continually depreciating paper money. Mm-hmm. But the moment gold comes back into the situation, I really do see that cryptocurrencies as a store of value go. Now, not to say that the technology of blockchain and various other uses, and also, probably will still be there as some sort of token money. But the delights of making lots and lots of money by buying Bitcoin at 5,000 and selling them at over 20,000 or whatever we hope, and people saying that it's going to run to 300,000 and so on, no, that disappears.
Mm-hmm. So one of the final points I'd like to hit here, Alasdair, is that I'd like to get your take on what the role, as you see it, of silver going forward in the event of a currency collapse is. Why will it be much more easy for people to return to using silver as money?
Well, that's a very good question. And it's actually a very difficult one to answer because there are so many bulls in the silver market that anything I say, I think they'll say, oh, this is a complete rubbish. Okay, so what I would say is that if we assume, and it is an assumption, mm-hmm. that the only outcome from this, which really works, is that the central banks mobilize their gold reserves, then the role of silver will not be as money. Now, this is important because if you go back to 1870, when Germany went on to the gold standard and went off the silver standard, and the rest of Europe in the early 1870s did exactly the same thing, that was the point where the price of silver fell sharply. It went from that sort of 15 ounces to 1 of gold sort of level down to 20, 30, and so on. So the important thing is that for silver to come back fully as money would make the price of silver somewhere between 20 ounces, less than 20 ounces to 1 of gold. I mean, you could argue it would be down to maybe 12 even. If, on the other hand, central banks are successful in bringing gold back, that is unlikely to happen unless central banks accept a dual role, if you like, two currencies, a bimetallic standard, where gold is fixed in the in the paper money on one basis, and you've got silver on another basis. In the past, that has created difficulties, and I think it is unlikely that a central bank would go down that route. So where does that leave silver? Silver, I think, as the situation unfolds, has tremendous upside. I see the gold-silver ratio certainly going below 50 to 1, below 40 to 1. 30 to 1, don't know, because of this problem that I've just stated. The other thing that, of course, could happen is that if the collapse is extremely rapid, which is beginning to look more likely, then any rational thought about, now, hold on a minute, what is going to be the outcome of this would be very much put to one side. And under those circumstances, I can see silver maybe even going down to below 30 to 1 against gold. But I just have this feeling in the back of my mind that a bimetallic standard would be rejected in any setup which involves sound money for the future. And I think also that industry would turn around and say, what industry there's left? The use value of silver is so enormous, in our electronic industries for controlling, sort of bacteria infections and all the rest of it. And, you've got 5G coming in. The use of silver is going to increase substantially, I think, on that sort of development. So I think the industrialists really do want silver for their own use. And of course, the other thing is that governments are pushing, sort of solar panels and all the rest of it. I mean, it's just, I don't know what it's like in Canada, but here, it's bloody well solar panels all the way from here to Scotland. I mean, it's just ridiculous and growing too. So that's my answer on silver. It's not a very satisfactory one, I'm afraid, for bulls of silver, but I think that we're a long way from having to take the decision as to whether how the future is going to actually look in terms of stabilizing the purchasing power of the money that we use day to day.
Mm-hmm. Yeah, I think that's an important point is that we kind of evaluate every possible outcome and try and figure out and readjust as they play out. Alasdair, why don't you tell us a bit more about where we can find you, where we can find out more about Goldmoney?
Yes, sure. Goldmoney, which is listed on the Toronto Exchange. I can't remember whether it's a junior bit or the other. Anyway, we are listed on the Toronto Exchange. We store gold, silver, platinum group metals for our customers. We act as custodians, as it were, and it keeps it out of the banking system, which I think with the fragility of the banking system is a very important point. And, I think we've got 11 or 12 vaults that we use around the world. So you can select where you want to store your gold, silver, whatever. Our website is goldmoney.com. And every Thursday, I publish an article, which is generally about sound money or is an economic analysis. And then on the Friday, I do a market report, which is published on goldmoney.com under the research tab. And these are released in sort of, I suppose, after lunch EST is probably the best way to describe it.
Excellent, Alasdair. I really appreciate the conversation today. We can find you as well on Twitter at Macleod Finance. And Alasdair, again, I appreciate your time today and thank you for coming on Palisades.
That was my pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.